Something is quietly breaking beneath the surface of the financial system, and almost no one is paying attention. Liquidity is tightening, confidence is thinning, and the kind of stress that doesn't make headlines until it's too late is already spreading through the banking sector. This is exactly how it starts, not with panic, but with complacency. If you've been around markets long enough, you learn that the real risks aren't the ones everyone is talking about. They're the ones hiding in plain sight. And right now, the signals are lining up in a way that should make serious investors stop, reassess, and act before the window to protect capital begins to close. The tightening doesn't announce itself with a headline or a dramatic sell-off. It seeps in gradually, almost invisibly, showing up first in places most people never think to look. Short-term funding markets start behaving differently. The cost of borrowing overnight creeps higher, not because demand is booming, but because trust is eroding. Banks begin to pull back, not abruptly, but just enough to matter. They lend a little less, hold a little more, and scrutinize counterparties a little harder. It's subtle, but it changes the entire tone of the system. What makes liquidity so dangerous is that it's not about solvency, at least not in the beginning. Institutions can appear perfectly healthy on paper, with strong balance sheets and adequate capital ratios, but if access to funding tightens, those numbers stop mattering. Liquidity is the oxygen of the financial system, and when it starts to thin out, even the strongest players begin to feel the strain. They don't collapse immediately, they adjust. And those adjustments ripple outward. You start to see it in lending behavior. Credit that was easily available 6 months ago suddenly comes with stricter terms. Lines of credit get reduced or quietly withdrawn. Deals that would have closed without hesitation are now delayed, renegotiated, or abandoned entirely. This isn't a policy decision, it's a defensive reaction. Banks are preparing, whether they admit it or not, for a scenario where access to cash becomes morphical. At the same time, the interbank market begins to send signals. Spreads widen, not dramatically at first, but enough to indicate growing caution. Institutions become less willing to lend to each other without a premium, and that premium reflects perceived risk, not actual losses. This is where perception starts to take over reality. Once doubt enters the system, it doesn't need confirmation to spread, it feeds on itself. The central bank can try to counteract this by injecting liquidity, but that only addresses part of the problem. You can add reserves to the system, but you can't force institutions to take risk. When confidence starts to erode, liquidity becomes trapped. It sits on balance sheets instead of circulating through the economy. This is why traditional measures of liquidity can be misleading. On the surface, everything looks fine. There's plenty of cash, but it's not moving where it needs to go. Markets pick up on this before the public does. You'll notice increased volatility in areas that are typically stable. Treasury markets, for example, may start to show unusual price swings, not because of changes in fundamentals, but because of positioning and forced adjustments. Hedge funds and other leveraged players begin to unwind trades not out of choice, but necessity. When liquidity tightens, leverage becomes a liability, and the unwind process adds pressure to an already fragile system. Corporations feel it next. Access to financing becomes more expensive and less predictable. Companies that relied on rolling over short-term debt find themselves facing higher costs or limited availability. This forces a shift in behavior. Spending slows, hiring pauses, and expansion plans get shelved. It's not a collapse, it's a contraction. But those small decisions, multiplied across the economy, start to add up. What's critical to understand is that this phase often goes unnoticed by the broader public. There's no immediate crisis, no visible panic. Economic data may still look stable, even strong in some areas. But beneath that surface, the foundation is changing. Liquidity is no longer abundant, it's selective. And selectivity is the first step toward restriction. Investors who rely solely on lagging indicators miss this entirely. By the time defaults rise or earnings decline, the liquidity cycle has already turned. The real signals in behavior, in how institutions act when no one is watching closely. When banks become cautious, when spreads widen quietly, When deals stop getting done, those are the signs that matter. And once that shift takes hold, it doesn't reverse quickly. Liquidity withdrawn has a way of staying scarce longer than expected. The system adjusts to a new reality, one where access to capital is no longer taken for granted. That adjustment process is where the real risk begins to build, because it sets the stage for everything that follows. And as that pressure builds beneath the surface, rising interest rates begin to act like a spotlight, exposing vulnerabilities that had been comfortably hidden during years of easy money. When capital was cheap and abundant, easy to mask, risk models looked stable, balance sheets appeared resilient, and assets carried valuations that assumed a world where funding would always be accessible. But when rates move higher, that assumption breaks down quickly. The first cracks show up in the most interest rate-sensitive areas. Long-duration assets, especially bonds purchased during periods of ultra-low yield, start to lose value as rates climb. On paper, these losses may be classified as unrealized, tucked away in accounting categories that suggest they don't matter until they do. Because while the accounting treatment may delay recognition, the economic reality is immediate. Those assets are worth less, and if they need to be sold to meet liquidity demands, the losses become very real. Banks, in particular, find themselves in a difficult position. They hold large portfolios of these assets, often financed by short-term liabilities like deposits. When rates rise, the value of their assets declines, but the cost of their liabilities increases. This creates a mismatch that wasn't a problem in a low-rate environment, but becomes increasingly dangerous as the gap widens. It's not a sudden failure. It's a slow erosion of stability. At the same time, deposit behavior starts to change. When interest rates were near zero, depositors had little incentive to move their money. It was convenient to leave funds sitting in a bank account earning minimal returns. But as rates rise, alternatives become more attractive. Money market funds, short-term treasuries, and other instruments begin offering yields that are hard to ignore. Slowly at first, then more noticeably, deposits start to flow out of the banking system in search of better returns. This shift forces banks to respond. To retain deposits, they need to offer higher interest rates, which increases their funding costs. But raising rates too aggressively compresses their margins, especially if their asset base is locked into lower-yielding investments. It's a delicate balance, and not every institution manages it well. Some are forced to accept shrinking profitability, while others take on additional risk in an attempt to maintain returns. Meanwhile, borrowers begin to feel the strain. Loans that were issued at low rates now reset at higher levels, increasing the burden on households and businesses alike. Adjustable rate mortgages become more expensive, corporate debt servicing costs rise, and projects that once made financial sense no longer do. This doesn't immediately lead to defaults, but it weakens the overall credit environment. The margin for error becomes thinner, and even small disruptions can have outsized effects. What makes this dynamic particularly dangerous is the lag between cause and effect. Rising rates don't trigger immediate crises. They set in motion a chain of events that unfold over time. Losses accumulate quietly, pressures build incrementally, and by the time the impact becomes visible, the system is already under significant stress. It's not the speed of the rate increase that matters most. It's the duration and persistence. Markets begin to reprice risk in response. Assets that were valued based on rates are suddenly worth less in a higher rate environment. Equity valuations compress, credit spreads widen, and volatility increases. Investors who were comfortable taking on risk when money was cheap start to pull back, leading to reduced liquidity and further pressure on asset prices. It becomes a feedback loop, where falling prices reinforce caution, and caution leads to even lower prices. The psychological shift is just as important as the financial one. For years, market participants operated under the assumption that central banks would step in at the first sign of trouble, providing liquidity and stabilizing conditions. But in a rising rate environment, that assumption becomes less reliable. Inflation concerns limit the ability of policymakers to ease aggressively, creating uncertainty about how much support will actually be available. This uncertainty changes behavior across the board. Banks become more conservative, investors demand higher returns for taking on risk, and businesses delay decisions that depend on stable financing conditions. The system doesn't break all at once, it tightens, constricts, and becomes increasingly fragile. And within that fragility, the weaknesses that were once invisible start to stand out clearly, not because they suddenly appeared, but because the environment no longer allows them to remain hidden. And that's where the real fault line begins to form, because in the end, banking crises are rarely about capital, they're about confidence. You can have an institution that meets every regulatory requirement, passes every stress test, and still finds itself in trouble the moment trust starts to slip. The system is built on the assumption that depositors believe their money is safe and accessible. The second that belief weakens, everything else becomes secondary. Confidence doesn't disappear all at once. It erodes in layers, often triggered by something that seems isolated or manageable. A rumor here, a report there, a sudden disclosure that raises more questions than it answers. None of these events are catastrophic on their own, but together they start to shape perception, and in financial systems, perception moves faster than reality. Depositors, especially large ones, don't wait for confirmation, they react to uncertainty. When there's even a hint that something might be wrong, the rational decision is to move first and ask questions later. This creates a dynamic where fear becomes self-fulfilling. The act of withdrawing funds doesn't just reflect a lack of confidence, it actively contributes to the problem. Liquidity drains faster, forcing institutions to respond in ways that reinforce the original concern. What makes this particularly dangerous in the modern system is the speed at which it can happen. Technology has removed nearly all friction from the process. Funds can be transferred instantly, at any time, without the need for physical presence or delay. What used to take days or weeks can now unfold in hours. A whisper of doubt can turn into a full-scale run before there's even time to assess the situation properly. Banks, despite all their safeguards, are not designed to withstand that kind of velocity. They operate on a model where only a fraction of deposits are held in liquid form at any given time. The rest is invested, lent out, or otherwise committed. This works perfectly well in a stable environment, but it becomes a vulnerability when confidence starts to falter. The mismatch between liquid liabilities and illiquid assets is manageable until it isn't. In response, institutions may try to reassure the market. Statements are issued, liquidity positions are highlighted, and management emphasizes the strength of the balance sheet. But once confidence is shaken, words have limited impact. Markets don't respond to reassurance, they respond to behavior. If deposit outflows continue, if counterparties pull back, if funding costs rise, those signals outweigh any narrative being presented. At the same time, other banks begin to take notice. Even if they are fundamentally sound, they adjust their behavior to protect themselves. Exposure to perceived risk is reduced, lending between institutions becomes more cautious, and liquidity is hoarded rather than shared. This amplifies the stress across the system, turning what may have started as an isolated issue into something broader. Regulators and central banks can step in, providing backstops and emergency facilities to stabilize the situation. These measures are designed to restore confidence by ensuring that liquidity will be available if needed, but their effectiveness depends on timing and credibility. If the response is seen as reactive rather than proactive, it may not be enough to reverse the momentum. What's often overlooked is how quickly sentiment can shift from indifference to alarm. In calm periods, risks are dismissed or ignored. But once confidence begins to crack, the same factors that were previously overlooked are suddenly scrutinized in detail. Investors and depositors start asking harder questions, digging deeper into balance sheets, and reassessing assumptions that were once taken for granted. This shift creates a kind of collective awareness that didn't exist before. Information spreads rapidly, amplified via and market commentary. Every new development is interpreted through a lens of skepticism, and even neutral data can be seen as negative. The narrative takes on a life of its own, influencing behavior in ways that go beyond the underlying fundamentals. And because confidence is intangible, it's incredibly difficult to measure or predict. There's no single indicator that tells you when it's about to break or when it's been restored. You only see the effects, flows of capital, changes in pricing, shifts in behavior. By the time those effects are visible, the process is already well underway. This is why confidence is the real trigger. Not because capital doesn't matter, but because capital only matters as long as confidence holds. Once that foundation is shaken, the system moves into a different state entirely, one where actions are driven less by analysis and more by the instinct to preserve, protect, and exit before everyone else does. And once that instinct takes over, the tightening in credit conditions begins to accelerate in a way that catches most participants off guard. What starts as a cautious adjustment by a few institutions quickly becomes a broader shift across the entire system. Lending standards don't just tighten, they recalibrate. Boons from asking how much they can lend to questioning whether they should lend at all. That change in mindset is subtle at first, but it spreads with remarkable speed. You see it in the approval process. Deals that would have been routine suddenly face additional layers of scrutiny. Risk committees become more active, assumptions are challenged more aggressively, and margins of safety are widened. It's no longer about capturing opportunity, it's about avoiding loss. And when that priority shifts, the flow of credit begins to slow, not because demand disappears, but because supply is deliberately constrained. Borrowers feel this almost immediately. Access to capital becomes less predictable, and terms that were once negotiable become fixed. Interest rates rise not just because of central bank policy, but because lenders are pricing in uncertainty. Covenants become stricter, collateral requirements increase, and flexibility disappears from agreements. For businesses that rely on steady access to financing, this creates a kind of quiet pressure that builds over time. Small and mid-sized companies are often the first to feel the impact. They don't have the same access to capital markets as larger corporations, so they depend heavily on bank lending. When that channel tightens, their options narrow quickly, projects get delayed, inventory levels are reduced, and hiring plans are put on hold. These are not dramatic moves, but they represent a shift from expansion to preservation. Larger institutions are not immune either. Even with access to broader funding sources, they face rising costs and increased scrutiny. Bond issuance becomes more expensive, and investor demand becomes more selective. Deals that would have been oversubscribed in a different environment now struggle to gain traction. This forces companies to rethink their strategies, prioritizing liquidity over growth and stability over ambition. At the same time, credit markets begin to reflect the change in sentiment. Spreads widen more noticeably, particularly in lower quality segments. Investors demand higher compensation for taking on risk, and that demand reshapes the pricing of debt across the board. What was once considered a reasonable cost of capital becomes unsustainable for certain borrowers, pushing them to the sidelines. This creates a feedback loop that reinforces the tightening. As credit becomes more expensive and less available, economic activity begins to slow. Slower activity increases the perceived risk of lending, which leads to even tighter conditions. It's not a sudden contraction. It's a gradual squeeze that becomes more restricted with each passing cycle. Financial institutions, aware of this dynamic, become increasingly defensive. Balance sheet management takes priority over growth, and liquidity buffers are increased as a precaution. This behavior, while rational on an individual level, contributes to the broader contraction. When everyone pulls back at the same time, the cumulative effect is significant. You also start to see a divergence in the market. Stronger borrowers with solid balance sheets and reliable cash flows can still access credit, albeit at higher costs. Weaker borrowers, however, find themselves effectively shut out. This widening gap creates pockets of stress that can develop into larger problems if left unaddressed. Defaults may not spike immediately, but the conditions for them are being set. What makes this phase particularly challenging is that it often unfolds without a clear trigger. There's no single event that marks the turning point. Instead, it's the accumulation of small changes, tighter standards, higher costs, reduced availability that gradually reshape the landscape. By the time the impact becomes obvious, the system has already adapted to a more restrictive environment. Investors who are paying attention begin to notice the shift in behavior rather than waiting for confirmation in the data. They see the deals that aren't getting done, the terms that are becoming less favorable, and the growing caution among lenders. These are the signals that matter because they indicate a change in direction before it shows up in traditional indicators. And as those signals multiply, the availability of credit continues to contract, not in a dramatic collapse, but in a steady, deliberate tightening that leaves less room for error with each passing moment. And in the middle of all this, what stands out most is how calm everything still appears on the surface. Markets aren't in free fall, headlines aren't screaming crisis, and the general tone remains oddly optimistic. That's where complacency takes hold. It thrives in the gap happening beneath the surface and what is visible to the majority. When the early warning signs are subtle, they're easy to dismiss, especially after years of stability where every disruption was quickly contained. Investors begin to anchor themselves to recent experience. They've seen volatility come and go, shocks absorbed, and recoveries unfold faster than expected. That memory shapes expectations, creating a belief that whatever is developing now will follow the same pattern. It's a powerful bias because it's rooted in real outcomes. But it also blinds participants to the possibility that the underlying conditions have changed. You start to hear the same narratives repeated with increasing confidence, that the system is well capitalized, that regulators are prepared, that any stress will be managed effectively. These statements may be true in isolation, but they become dangerous when they lead to inaction. The assumption that risks are contained often prevents people from recognizing when those risks are evolving into something more serious. At the same time, asset prices don't always reflect the growing tension. Equity markets may continue to trade near highs, supported by momentum and selective optimism. Credit markets, while showing some signs of stress, may not fully price in the potential for deterioration. This disconnect creates a false sense of security. When prices remain stable, it reinforces the belief that everything is under control. Underneath that stability, however, positioning begins to tell a different story. Leverage remains embedded in parts of the system, often in ways that are not immediately visible. Strategies that depend on stable funding and predictable conditions continue to operate, even as those conditions start to shift. The longer this goes on, the more fragile the structure becomes, because it's built on assumptions that are no longer as reliable as they once were. What makes complacency so persistent is that it's self-reinforcing. As long as nothing breaks, the belief that nothing will break grows stronger. Each uneventful day becomes evidence that concerns are overblown. Warnings are dismissed as overly cautious, and those who act defensively are seen as missing out. This dynamic keeps risk in the system longer than it should be, allowing imbalances to grow. You can see it in how quickly negative signals are rationalized. A tightening in credit conditions is framed as normalization. Rising funding costs are seen as manageable. Even isolated failures are treated as exceptions rather than indicators. There's always an explanation that fits the current narrative, and that narrative tends to favor stability until it can't anymore. Meanwhile, the participants who are closest to the system, banks, institutional investors, large allocators, begin to behave differently. Even if they don't say so openly, they reduce exposure, increase liquidity, and become more selective in where they deploy capital. These actions are not driven by panic, but by recognition. They see the same signals, but they respond quietly, without drawing attention. This creates an asymmetry in the market. On one side, you have informed participants gradually de-risking. On the other, you have a broader base that remains engaged, comforted by the lack of visible disruption. That gap doesn't close through communication. It closes through price and event, and when it does, the adjustment tends to be abrupt. The danger is not just that complacency exists, but that it delays the response to changing conditions. By the time the majority begins to acknowledge the shift, the opportunity to act calmly has already passed. Decisions are no longer made from a position of strength, but from a need to react. That's when volatility increases, liquidity thins further, and the system moves from a state of quiet tension to one of visible stress. And all the while, the signals were there, subtle, persistent, and largely ignored because they didn't fit the prevailing belief that the system, as it had behaved in the recent past, would continue to do so without interruption. And when that belief finally gives way, the shift in priorities is immediate and unmistakable. The focus moves away from maximizing returns and toward one objective that overrides everything else: preserving capital. It's a transition that doesn't require a formal signal or announcement. It shows up in behavior, in allocation decisions, in the quiet but decisive actions taken by those who understand how quickly conditions can deteriorate once the balance tips. Risk, which once felt manageable and even desirable, is suddenly viewed through a different lens. Positions that were held with confidence are reevaluated with skepticism. The question is no longer how much upside remains, but how much downside is possible. That change alone alters the entire dynamic of the market. Because when enough participants start asking that question at the same time, the demand for safety begins to outweigh the pursuit of gain. You see it first in liquidity preferences. Cash, which had been considered inefficient in a low-rate environment, becomes valuable again, not for its return, but for ability to act, to respond, to move without constraint, takes precedence over being fully invested. This isn't about abandoning opportunity, it's about recognizing that opportunity looks very different in a stressed system than it does in a stable one. Portfolios begin to shift accordingly. Exposure to higher risk assets is reduced, sometimes gradually, sometimes all at once. Positions that depend on favorable conditions, tight spreads, ample liquidity, stable funding, are scaled back or exited entirely. In their place, more defensive allocations emerge: short-duration instruments, higher quality credits, and assets with lower volatility start to take on greater importance. At the same time, leverage is reassessed. What once enhanced returns now represents a source of vulnerability. Even modest levels of leverage can become problematic when liquidity tightens and asset prices move unpredictably. The process of deleveraging, whether voluntary or forced, adds pressure to markets that are already adjusting to reduced risk appetite. It's not just about individual decisions. It's about the cumulative effect of many participants moving in the same direction. Institutions, in particular, become more disciplined. Risk management frameworks that may have been relaxed during periods of stability are enforced with greater rigor. Limits are tightened, exposures are monitored more closely, and stress scenarios are taken more seriously. These actions are not reactive in the traditional sense. They're preemptive, designed to ensure that if conditions worsen, the impact is contained. What's important to recognize is that this phase often occurs before the full extent of the problem is visible. The data may not yet reflect a downturn. Defaults may still be low, and economic indicators may appear stable, but the shift in behavior is already underway. Those who are paying attention don't wait for confirmation, they act on the signals that others are still debating. This creates a divergence in outcomes. Participants who agilely have the flexibility to navigate changing conditions with a degree of control. They can choose where to allocate, when to deploy capital, and how to manage risk. Those who delay, who wait for clarity or reassurance, find themselves operating in a more constrained environment, where options are limited and decisions are driven by necessity rather than strategy. As this process unfolds, markets begin to reflect the new priorities. Volatility increases not just because of external events, but because of internal repositioning. Correlations change, and assets that once moved independently start to behave more uniformly. The search for safety becomes a dominant theme, influencing pricing across multiple sectors. Even sentiment undergoes a transformation. Optimism gives way to caution, and caution gradually turns into concern. The narratives that once supported risk-taking are replaced by ones that emphasize resilience and protection. It's not an abrupt reversal. It's a progression shaped by experience and reinforced by observation. And through it all, the underlying principle remains constant. In uncertain environments, survival takes precedence over success. The goal is not to outperform, but to endure. Because in systems where liquidity is constrained, confidence is fragile, and credit is tightening, the ability to protect capital isn't just a strategy. It becomes the difference between being able to participate in what comes next and being forced to recover from what just happened.